In Amazon's early years, critics argued that its valuation made no sense. Its price-to-earnings ratio was sky-high, and it wasn't making consistent profits. But Jeff Bezos and long-term investors understood that traditional valuation methods, like price-to-earnings, were not suited for high-growth tech companies. Instead, forward-looking valuation models like discounted cash flow, abbreviated as DCF, which projected Amazon's future cash flows, showed the massive upside potential. This perspective helped early investors stick with the company and reap exponential returns over time. Valuation is the process of determining the present worth of a company or asset. It helps investors decide whether a stock is overvalued, undervalued, or fairly priced relative to its fundamentals. Discounted cash flow is a method of valuing a company based on its expected future cash flows discounted to present value. The formula for present value is the sum of cash flow in year end divided by 1 plus the discount rate raised to the power of n. The key inputs include projected free cash flows, the discount rate, usually the weighted average cost of capital or WACC, and the terminal value. The strength of DCF lies in its strong theoretical foundation. However, its weakness is that it is highly sensitive to assumptions. This method compares a company's value to others in the same industry using key multiples. The price-to-earnings ratio is calculated as price divided by earnings. The enterprise value to EBITDA ratio is calculated as enterprise value divided by EBITDA. The price-to-book ratio is calculated as price divided by book value. The price-to-sales ratio is calculated as price divided by sales. This approach provides a quick way to see how a company stacks up against peers. Discounted cash flow is best used for companies with stable and predictable cash flows, such as utilities. Multiples are more appropriate for high-growth or cyclical companies where forecasting cash flows is harder. Technology startups may not yet have earnings, so revenue-based multiples like price to sales are more relevant. Common pitfalls in valuation include overly optimistic growth assumptions in discounted cash flow models. Another mistake is comparing companies with vastly different business models. Ignoring debt in valuation is also problematic. In such cases, using enterprise value-based multiples instead of just market capitalization is more appropriate. Additionally, forgetting the impact of macroeconomic conditions, such as the influence of interest rates on discount rates, can lead to inaccurate conclusions.